They've been telling you this your entire life. Renting is throwing money away. Buying a home is always the smarter financial move. That idea is so deeply ingrained that most people never question it. But when you actually run the numbers, under realistic assumptions, the opposite can be true. In this scenario, the renter ends up with $5 million, and the homeowner ends up with $3.5 million. Same income, same discipline, same investment returns. The difference is not effort. It's where the money is allowed to compound. Homeownership has been sold as the ultimate financial milestone. And for a long time that made sense. Lower home prices, lower interest rates, lower price-to-rent ratios. But those conditions have changed. The myth that buying is always financially superior hasn't kept up with reality. Today, I'm not going to tell you what you should do. I'm going to show you what the math actually says when you stop comparing rent to a mortgage payment and start comparing capital allocation. We're comparing two people who are financially identical. Both have $3,400 per month available for housing and investing. Both see that amount grow 3% per year with annual raises indexed to inflation. Both invest any unused cash into a diversified stock index earning 11% annually. The only difference is renting versus buying. Buyer purchases a $500,000 home, $100,000 down. $400,000 mortgage, 6% interest. 30-year fixed rate. Monthly principal and interest, $2,400. Now add the other costs. Property taxes, $5,000 per year. Insurance, $2,000 per year. Maintenance, $5,000 per year. Year 1 total, about $3,400 per month. So buyer has nothing left to invest initially. Buyer's home appreciates at 4% annually, ending around $1.6 million. Buyer also builds an investment portfolio as free cash flow grows. Most people have heard of the 1% rule. The 1% rule says that a home should rent for about 1% of its value per month. So a $500,000 home would rent for about $5,000 per month, or $60,000 per year. That implies a price-to-rent ratio of 8.3. It's calculated as median home price divided by median annual rent. The price-to-rent ratio is a financial metric comparing the cost of buying versus renting in a market. Lower ratios favor buying, higher ratios favor renting. As a rule of thumb, below 15 tends to favor buying. Above 21 tends to favor renting. Historically, price-to-rent ratios were much lower. But over the last several years, home prices have risen far faster than rents. Today, the U.S. average price-to-rent ratio is 14.3. If the median home price in a market is $500,000, then the median rent price in that same market would be $35,000 per year in rent, or about $2,900 per month. In large cities, price-to-rent ratios are often 18 to 25 plus, which makes renting even more attractive. This is why you must look at your market. Now I know what you're thinking. If you rent, your costs go up every year. If you buy, you lock in your mortgage payment. Let's look at the math. Renter starts at $2,900 per month. Rent grows 3% annually. Total rent paid over 30 years, $1.67 million. Buyer, people think the buyer's cost is just the mortgage. But property taxes rise, insurance rises, maintenance rises. Over a 30-year period, mortgage, $864,000. Property taxes, approximately $280,000. Insurance, approximately $114,000. Maintenance, approximately $285,000. Total, $1.54 million. So yes, rent goes up. But buyer's total housing cost also goes up. And the difference is only about $130,000 over 30 years. Now I know what you're thinking. If you buy, you save money on taxes. Yes, you do. But the benefit is smaller and more temporary than most people expect. Early on, mortgage interest is about $24,000 per year. Property taxes are about $5,000 per year. Even after caps, maybe $10,000 to $12,000 of incremental deductions remain. At a 32% tax rate, that's about $3,000 to $4,000 per year in tax savings. That benefit shrinks every year, often disappears mid-mortgage. Over 30 years, we assume about $100,000 total in tax savings. That's helpful, but it doesn't come close to offsetting the opportunity cost of investing at 11% annually. This is where the real gap comes from. Historically, the stock market has returned about 11% annually over the last 90 years. Home prices have appreciated about 4% annually over the last 50 years. Real estate returns are market dependent. Some cities outperform, some underperform. But most people don't realize that long-term stock market returns dramatically outpace housing appreciation. So when the renter invests earlier and more consistently, those dollars compound at nearly 3 times the rate. That is what creates the $1.5 million net worth gap. Not rent versus mortgage payments, opportunity cost. Let's pause and actually break down what those numbers mean, because this is where the story becomes real. The renter doesn't magically end up with $5 million. It comes from 2 very simple, very repeatable behaviors. First, the renter invests the $100,000 they didn't use for a down payment. That one decision alone grows to about $2.3 million over 30 years at an 11% annual return. Second, the renter invests the difference between what they can afford to spend and what they actually spend on rent. In year 1, that's about $500 per month. That contribution grows with inflation, and over 30 years it compounds into another $2.7 million. Add those together, and the renter ends up at about $5 million. Now look at the buyer. The buyer's wealth is split across 2 buckets. The home itself grows from $500,000 to about $1.6 million at a 4% annual appreciation rate. At the same time, as free cash flow increases over the years, the buyer is able to invest as well, building an investment portfolio of about $1.9 million. Put those together, and the buyer ends up at about $3.5 million. Same discipline, same effort, different outcome. Not because one person was smarter, but because one person let more capital compound at a higher return for a longer period of time. This is not a one-size-fits-all decision. There are real financial and lifestyle factors that should shape whether buying or renting makes sense for you. Buying a home can be the right choice if you are ready to put down roots. If you are starting a family, have a stable career, and know you want to stay in one place for decades, the stability of homeownership can be incredibly valuable. It also makes sense if you want the freedom to customize your space, renovate, or build something that truly feels like your own. From a financial perspective, buying can make sense when the math works. That means looking at the true cost of ownership in your market, interest rates, property taxes, insurance premiums, maintenance, and how those costs are likely to change over time. In a low interest rate environment and in markets with low price-to-rent ratios, buying can absolutely be the financially prudent choice. But renting is not a consolation prize. Renting offers a different kind of advantage. Lower stress, because you are not responsible for repairs and maintenance, which can be expensive, unpredictable, and time-consuming. More time, because you are not managing a property, coordinating contractors, or dealing with constant upkeep. That time can be reinvested into your career, your skills, your side projects, your health, and your relationships, all of which can increase your earning power and your ability to invest. Renting also gives you flexibility. You can move quickly for career opportunities. You can change cities or states without paying tens of thousands of dollars in selling costs. You can explore different lifestyles and geographies without being locked into a single decision. In today's world, that flexibility has real financial value. So yes, buying can still make sense when the conditions are right. Stability, long-term roots, favorable price-to-rent ratios, lower interest rates. But renting offers something equally powerful: flexibility, freedom, optionality, no repairs, no maintenance, no stress, low switching costs, and the ability to align your life with opportunity instead of being anchored to a single asset. That is why this decision is not about following a rule. It is about understanding the math, understanding your life, and choosing deliberately.